But I don't think it stops there, because we also have the inflation of the 70s or worse, and then we also have a real estate bubble that's been reinflated, and then you have what's going on in China with those real estate developers and that debt market. I'm a fan of the work of Jeremy Grantham at GMO, and he points to maybe 2 or 3 super bubbles that we're contending with here. So what do you think about that? That this is not just .com, not just the Great Recession, not just the 70s, but actually all 3 and possibly more all at once?
I think that might be a little dramatic, but I think it's
this is YouTube, Rick.
the interest.
Hello, Albert Liu here, back with Rick Rule. Welcome to the channel. Rick, good to see you. How are you?
A pleasure to be with you, Albert. Thank you. I'm fine.
Happy Friday to you. Not a happy week in the markets. Let's go through. I guess I have a laundry list of stuff I want to go through, including getting to some of the questions that people had at the Uranium Bootcamp, as well as your thoughts on uranium in general. But I want to start with the markets in general, Rick. It's been a very volatile time in the general markets, and just want to get your thoughts on this in general to start.
Well, 2 primary thoughts. I think that the volatility is long overdue. I had suspected that this period of volatility would come to us long before it has. I suspect that the reason it was delayed is because the liquidity's gone away. 2 years ago, 2.5 years ago, the Fed was pumping liquidity into the market and continuing to lower interest rates. And there's nothing like cash to act as a soporific. Now that there's less liquidity in the market, it's pretty obvious that the volatility that should have been with us before is with us now. It's interesting too, Albert, that people don't regard moves to the upside as being volatility. When somebody owns a stock, their conviction around the stock means that when it goes higher, it's the normal and natural outcome of the world as it should be. And when a stock goes down, there's some form of unnatural act taking place. I guess the third comment I might have is that if you are a speculator or an investor who is active and wanting to become more wealthy over a real period of time, that you should welcome downside volatility. I've always said that cyclicality represented occasional sales. Volatility represents frequent sales, maybe not as dramatic as cyclicality. But I have to say that anybody who is surprised by this volatility needs to kind of give their head a shake.
Rick, I think volatility is the parlance of money managers who, well, like you said, when things are going well, it's maybe attributed to alpha or skill, and when things go bad, it's volatility, or all kinds of Greek symbols and words come into the play. So let's not blame the retail investor for everything. But one thing I want to point out to the people watching, in case they're not familiar with business cycle theory or the Austrian theory, is just the broad-based nature of the selling. And one of the hallmarks of the business cycle is when businesses that are seemingly unrelated all appear to fail at once. And that's definitely what we're seeing here. I mean, certainly the crypto complex is in the news, but so is fintech, so are the automakers, so are the retailers. I mean, it just seems to go on and on and on. Mining stocks have not been exempt. Gold has held up very well, but the mining equities, the gold equities have been punished a little bit. So speak to that, Rick, the broad-based nature of the sell-off and relatively few places to hide for the investor at this point.
Well, I think no places to hide, probably. Let's deal with them back in reverse order. And I think there's really 3 comments around that. The first is, again, I think it's liquidity driven. When you take the vodka out of the punch bowl, the party becomes less frenetic. Buffett famously said, when the tide goes out, you can see who was swimming naked, and lots of us were swimming naked. I suspect that one of the things that happened is that asset prices generally got ahead of themselves after what was, in effect, a 40-year bull market with some punctuation in the period 1982 to 2022. And I think that maybe some sense of reality is returning to the market. So, in other words, some of what we're seeing across a lot of asset classes is mere reversion to mean. But there are other things that one must consider too. Rising interest rate means that the cost of capital for various enterprises goes up at the same time that the capitalized value of their dividend distributions goes down. So when both the numerator and the denominator are challenged, the equation starts to become problematic. What we're seeing in equities markets is, once again, a reminder that in the near term, stocks are stocks, irrespective of what sector that they're in. And we have been in a period where there was less fiscal stimulus, and so hence less monetary liquidity. But at the same time, the trading volumes across many equity platforms have slowed down. And while that trading volume has slowed down, the importance of the program traders, the algorithmic traders, has increased, while the algorithmic traders' use of options has increased. So the very structure or the changing structure of the equities markets tells you that in periods of time where there was less liquidity, where the market was more driven by algorithmic traders, and where the algorithmic traders themselves were using more leverage in their trades, that you had set yourself up for a market that would be at least charitably described as choppy. The final comment I would have, Albert, is that some of this broad-based retreat has to do with the fact that we're facing a real systemic long-term rout in the debt markets. If you think about the fact that the largest institutional investors in the world have run for 40 years on an asset allocation model that was 60% equity, 40% debt, and you think about the obligations that these institutional investors have. If you run the Stanford Endowment, you have to look after students 15 or 20 years from now. If you run CalPERS, you have to look after retired public employees 15 or 20 years from now. If you think about the 15 or 20-year obligations that they have, and you think about the fact that they have 40% of their assets in investments that are yielding 3 or 4, while the purchasing power of the currency that they will need 15 or 20 years from now is falling by 8.5%, you understand the need of the largest investors in the world to diversify out of a very large asset class. That's an important part of the market. That isn't to say that bond prices can't go up if the Fed has to lower interest rates. What I'm saying is that as long as you have very large negative real yields, and as long as the prospect for those large negative real yield continues, you are going to have increasing disintermediation, a fancy word for selling, in the bond market. And I think that disintermediation in the bond market is one of the principal causes of the malaise in other sectors.
Rick, you mentioned some of the factors that would affect mining stocks, gold equities, in particular, input costs, as well as cost of capital and the discount rate. GDX is down about 5% on the year. So not too bad considering what we're seeing in the market. Apple itself is down over 20% from its high. But it was down almost 10% this week. The GDXJ down 14% for the year, down 10% on the week. I'm wondering which of the factors that you mentioned or factors that you haven't mentioned are weighing most heavily on the sector. Is it, for example, the repricing, the bond yields changing, affecting basically the premium for duration, or is it input factors as you mentioned? What exactly do you think is weighing most heavily on the sector right now?
With regards to the gold stocks, I think they had less far to fall. They were relative, the prices relative to easy to establish values were more reasonable than other sectors. And the consequence of that is that when they got whacked less hard. But we have learned in other crises in confidence, in other liquidity squeezes, that in the near term, all stocks are stocks. I remember very well the 1987 crash, 2 days after I got married. The gold stocks held together for one day. And after that, they, like the other stocks, got hammered. Now, it's true that they came back faster than the rest of the market. The same circumstance happened in the 2008 crash. The gold stocks held in for a minute, and then the gold stocks recognized they were stocks, because the selling decision in a leveraged market like this isn't necessarily made by the investor. It's often made by the margin clerk. And the margin clerk doesn't care particularly about the description of an asset. They just care about whether there's a bid for it that can reduce the debit balance. So, my suspicion is that gold stocks' delayed reaction was understandable, because unlike some other aspects of the market, they weren't overvalued. In fact, I would argue that they were cheap. But ultimately, when you have a liquidity squeeze and a crisis in confidence, it hurts everyone, the gold stocks included. I would say too that the down moves have been particularly vicious in tertiary assets, which is to say marginal assets. So the lesser known cryptocurrencies, while Bitcoin might have had a 35% decline, some of the lesser known cryptocurrencies have fallen by 65 or 70%. There's probably no asset in the world that's more marginal than a gold exploration company in a country that most people can't pronounce. And it has been those assets on the periphery that have been particularly hard hit. So if you look at the GDXJ relative to the GDX, you'll see that the allegedly junior index was much more grievously damaged, than the senior index was. And I suspect that continues for a little while.
Last time we talked about this, I asked you that exact question. You said the juniors don't deserve to be priced higher than they are. I imagine you still feel the same way.
I do. I continue to believe that although I made my reputation and frankly my fortune on companies with less than $1 billion in market cap, what I see in the market today is that I'm not getting paid to take the risks in the juniors that would be appropriate. I think that the larger companies throughout the resource spectrum have a better relationship of price to value relative to the juniors than they traditionally have. That doesn't mean that there aren't some juniors that will do extraordinarily well. What I mean is that as a class, the higher quality resource companies relative to risk are cheaper than the lower quality resource companies. And the consequence of that is that I'm concentrating my efforts there. Looking forward to, frankly, a point in time where the turbulence in the market continues to the point that I can return to the more speculative part of the market and find the types of bargains, that we saw as an example in the decade of the 90s.
Rick, tough times for investors are often very interesting times for people who are students of markets. And I'm finding that this is indeed a very tough time for investors. But the part of me that likes to study markets is just fascinated right now. And you mentioned cryptos before, so I want to talk a little bit about what's going on with Terra and Luna. I don't know if you've been following that. I am by no means an expert in cryptos, or even barely conversant actually in cryptos and these stable coins. But I know what a bank run looks like. I know what happens when a money market fund breaks the dollar. And I know what happens to the equity tranche of a fancy financial instrument when things start going south. And that's exactly what it looked like with Terra Luna. Did you follow it at all? And do you have any comments?
A little bit. Let me say, Albert, that I have many, many, many bad habits as an investor and a speculator. But one of them is not investing in things I don't understand. And so I followed Luna a little bit, just as you suggest, as a sort of a horrified outsider. I didn't have any visceral experience with it because I never had the cash, I never had the courage to own it. I would simply point out that people who buy financial constructs, irrespective of what they're called, a leveraged money market fund, which almost seems like an oxymoron, or some type of cryptocurrency, in particular a tethered currency. People who buy financial instruments that are complex, that they don't understand, court disaster. I would point to, particularly with regards to the tethered coin, that there was always a suggestion that these were backed by US dollars or backed by some other assets. That's not right. They were measured against them. They weren't backed by much of anything. And so when you describe what happened to those coins, those instruments, pardon me, as being bank runs, in a sense, you're exactly correct. If you had a bank that was poorly capitalized, where it had a 5% equity slice against a 95% debt slice, and then a couple of their assets went south, it wiped out the equity. That's precisely, I think, what happened in the context of these instruments. There was a fairly thin slice of, quote, equity that was responsible for maintaining the peg to the tether. It wasn't as though they had issued $3 billion worth of coins and used that $3 billion worth of coins to buy $3 billion. The cryptocurrency, the tethered cryptocurrencies have always, in a sense, been a floating abstraction. They are measured in the underlying instrument, but not denominated in them or not backed by them. And I think people needed to understand that. And I think people are getting, with regards to UST as an example, a very fresh understanding.
Yeah.
That.
Now, I think the advocates would point out that I think Tether differs substantially in that it does hold reserves, US dollar reserves against their issues. But in the case of Terra Luna, that was never even claimed. And so, you're not a player in the crypto industry, but you do know a lot about banking. And I don't think an algorithmic reserve would work in a real bank. I don't see why it would work in a crypto stablecoin either.
Well, I think what you need to do in the tethered community is determine to what extent the asset base that's denominated by the coin is reflected in the market capitalization of the coin, and understand what the insurance mechanism is. If a coin comes to have the impact of an ETF, as an example, a lower friction ETF, there are still charges to the corpus of the estate for buying currency and selling currency. In other words, for maintaining the corpus of the tether. And those expenses have to come out of somewhere. What generally happens is that there is a float, which is to say there is a shortage of, if you will, collateral, or a shortage of the underlying custodied asset relative to the market capitalization of the instrument. And individual investors, to the extent that they are able to know, need to know that. From my viewpoint, because I could never know how to know, I just didn't buy. The whole crypto fear of missing out thing, where you didn't buy it at 10,000 and now it's at 20,000, and something that you didn't understand at $10,000 is now twice as expensive. So you have to pay up for your own ignorance. It's never anything that made any sense to me, which is, in retrospect, merciful.
Yeah, I think a lot of people are learning a hard lesson similar to the one that I learned in the dot-com bust. So I have empathy for those folks who are going through this now. Some people I've heard kind of jokingly referring this as a Luna moment in reference to Lehman Brothers and how that kicked off a very bad time in the market. But I think what makes this time very scary, Rick, is you could indeed look at the crypto complex and draw an analogy, I think, to the dot-com era. But I don't think it stops there, because we also have the inflation of the 70s or worse. And then we also have a real estate bubble that's been reinflated. And then you have what's going on in China with those real estate developers and that debt market. I'm a fan of the work of Jeremy Grantham at GMO, and he points to maybe 2 or 3 super bubbles that we're contending with here. So what do you think about that? That this is not just .com, not just the Great Recession, not just the 70s, but actually all three and possibly more all at once?
I think that might be a little dramatic, but I think it's
This is YouTube, Rick.
the interesting thing about that is that you left out the thing that scares me most, which we'll get to. I think the unwinding of speculative assets is the prices of speculative assets is something that will hurt individual investors. I think it'll be good for equities markets, to be honest with you. I think the simultaneous reset, particularly a simultaneous reset in an inflationary environment, is scary. I mean, it really, truly is scary. I don't think that investors and savers and voters worldwide are thinking about inflation yet. I think they see it, but this reminds me, in terms of the response to inflation, of nothing so much as the 1968 to 1972 period, where although I was too young to experience inflation a lot, I was studying it. And there were 4 years, really, where inflation was sort of out of control, but nobody cared because they'd lived through 20 benign years before it. It was only after 4 years of getting pay raises, but getting pay cuts in real sense, and having the purchasing power of their savings decline, seeing the prices of everything go up to the extent that they were becoming unaffordable, that people paid attention to inflation. So if you think about the potential of the psychological aspect of declining markets, and you add on to that the dawning realization that with negative real yields, people are losing money on their savings. And then you add on to that the understanding that inflation isn't transitory and that there might not be room in the economy to raise interest rates fast enough to deal with inflation. And you have the potential, I'm not saying it's going to occur, but you have a potential for a real rout. The ugly difference, Albert, for me, between this crisis in confidence, if that's what it is, and others that I've experienced in my life, is it would seem to me that the Fed, among others, doesn't have very many tools left in the kit. If you look as an example to the economic challenges that the United States faced in the 1970s, we went into the 1970s with aggregate federal debt at about 20% of GDP. Now we have aggregate federal debt at about 115% of GDP. And if you add back the net present value of unfunded liabilities, it's a much, much, much larger number. At the same time, traditionally, we've dealt with circumstances like this by lowering the interest rate. But lowering the interest rate substantially when people are already facing a very substantial negative yield on their savings becomes problematic. So the thing that scares me in this whole circumstance is, first of all, the faith among voters and investors that the Fed, that the government, that the collective has their back. In fact, the expectation that they should have their back. And the other expectation, or not expectation, but the other realization that the big thinkers in the world collectively have fewer tools at their disposal to buy us more time. That's what scares me. Going into this circumstance substantially weaker than we went into the circumstance 50 years ago, at the same time that we have a greater expectation on the part of the citizenry that the big thinkers of the world will solve the problem. It has occurred to me for a long time, Albert, that we were due for a reckoning. We're having a reckoning. Reckonings are good. They're painful. The sooner that you get through this, the sooner that you move on. But the period of moving through this will be, I think, will continue to be turbulent.
Rick, I'm going to double down on the drama here because as we speak, or
the always cheerful Albert Liu,
in around this time, those big thinkers you refer to are meeting. and discussing
Yes.
possibly price controls on energy and things like that. And what's worse than prices going up on things that we absolutely need are not being able to get at any price, things that we need due to shortages. So that's going on. But the other thing that concerns me is I think we could be looking at sort of a period loss of wealth that we've never seen before. Because if you look at other periods and go back all the way to the Great Depression, when obviously there was catastrophe, stock market plunge, all of those things, price controls, all of those things that were bad. If you read Murray Rothbard's book on the Great Depression, despite their best efforts, the Fed was not able to inflate its way out of it. They actually had deflation. So people who had money actually did okay. And if you go to the 80s, well, at least you had Paul Volcker bringing things back. And again, if you had cash, you yielded very well on that cash. And I think today we're going to have the same loss of wealth due to the market, due to the liquidation that you get from a business cycle. But I think these big thinkers, they've evolved too, and they're much better at executing their mischief. They're much more creative. It's not just reserve ratios that they're tinkering with. They have all kinds of fancy toys that they use. And you also have collaboration with international powers, which delays the consequences of any domestic efforts to mess with the market. So, and maybe it is just me not being a cheery person, but I just see, and I'm not saying this is going to happen tomorrow or next year, but it just seems that the potential is there for something much worse. There was, not to mention that there's a cumulative effect to all of these mistakes we've made over the decades. And sooner or later, as you say, there is a reckoning. If that reckoning happens in whole, not in part, things could get very, very bad in my calculation. Your thoughts?
I think the longer you put it off, the worse it gets. I think had we dealt with these excesses as late as the early part of the decade of the 2000s, that we could have had a fairly ugly, fairly brief downturn, not unlike the downturn that we had in 81, 82, 83, 84. We didn't. And there's two downsides to that. The first is that the problem is much bigger. The second is that the citizenry believes that they should get through this without having a problem. It's as though a bunch of college students think that they should be able to drink rum punch all night and not have a hangover. That's not the way it works. So there's an expectation, sadly, that the big thinkers should or can do something about this. From my point of view, that's extremely problematic. Now, I will take issue with you in something that you said, and it may be a semantic issue. You said that wealth disappears. That's not true. It gets redistributed. Doug Casey famously said that a bear market returns capital to its rightful owners, the wise. For people who are unwise, there's small solace in that. But the fact that a house in your neighborhood goes from being valued at $2 million to $1 million doesn't change anything to do with the bricks, the mortars, the landscaping, or in fact the utility of the house. Maybe there's some deferred maintenance. It just changes who owns it. I would suggest to you that since none of us individually, or you and I collectively, have the ability to alter the affairs of humankind, that our obligation is to ourselves, our families, and our clients. The fact that most people are unprepared psychologically or financially for what is likely to come doesn't mean that people who are listening to this broadcast don't have, first of all, the obligation, but second of all, the opportunity to weather the storm as best they could, or, as you might suggest, prosper. You'll recall, Albert, in most of the interviews that you and I have done over the last 18 months, I have suggested to people that they maintain a lot of liquidity despite the fact that they lose purchasing power on the cash. I believe that negative real yield is an option premium for having the cash, whatever kind of cash you hold. Gold is fine with me. But I want people to have enough liquidity so in times of turmoil, volatile turmoil, that they have both the tools and hopefully the courage to take advantage of the circumstance as opposed to being taken advantage of by the circumstance. Now, this may be a vain hope, When I read the public comments around the various interviews that you and I do in YouTube, it seems like, as an example, among the uranium community, if I say I'm bullish about uranium, it's going high. I'm just an absolutely lovely guy, young, fit, long hair. And when I talk about the fact that the uranium juniors may be ahead of themselves and you may need to prepare yourself for tough times ahead, I seem to be vilified. It's interesting. Uh, it's interesting the way people view the world.
It's the price of your celebrity, Rick.
I mean, I most of these people, when you talk to them individually, they're really good people, and you don't want them to have a bad outcome. It isn't so much about whether they love me or hate me, although that certainly amuses me. What bothers me is the abdication that people have chosen to take with regards to their own financial, educational, and psychological preparedness for the circumstance that's in front of us. I have made most of my money in bear markets and in times of chaos. I haven't cashed the check, but I've written the check that has caused my net worth to go up most aggressively during periods of time when other people were pulling in their horns. And mercifully for me, I've been pretty good at cashing checks when other people have been eager to write them. But one of the reasons that I don't invest or speculate outside natural resources or financial services is outside of those areas, I don't have the ability to do valuations. It's easy to see the price of something. It's much more difficult to determine the value. What bothers me is that too many people who otherwise are fairly well informed don't understand the relationship between price to value and value to narrative and market sentiment. And that, in addition to their related reliance on the big thinkers to solve their individual problems, is what scares me the most.
Rick, I have a couple of points I want to move on to, but not before I object to your objection of my use of the word wealth being destroyed. I see your point, but what I was referring to is the wealth that would have been created but wasn't. So perhaps it was not physically destroyed, but whenever capital is squandered, whether it's in a casino or on some project that leads to no output, the use that it could have been put to fails to come into existence. So in that sense, that's what I meant, sort of in a Henry Hazlitt sort of way. The unknown, the unknown wealth that would have been created isn't created, and that's what happens when you have malinvestment, as we have had. Yep. All of the, I don't want to, beat up on crypto when they're obviously hurting, but not all those companies have to exist. So anyway, that was my point. We have, let's see. I want to talk about going back to our discussion on the last video, which was quite some time ago, but about your Russia strategy. And the moves that you made, and as you did them, you cautioned all of us on some of the things that could happen, particularly political interventions, which happened. If you look at the comment section. Oh, by the way, your comment. This is the other thing I was going to say. Your comment about people in the comment section. The ones that you point out there are, you have to concede they're a very, very small fraction of the comments we get on these videos. Most of them are not. So hopefully.
That's accurate. And we actually have a wolf pack of defenders when people criticize us, which is amusing too.
Yeah. So I think most people are not, if it makes you feel better, most people are not abdicating their responsibility. Most people are quite grateful for the information and the knowledge that you're sharing here. But yeah, just to close or to punctuate the moves you made on the Russia incidents. Tell us, sort of summarize what happened, what your thoughts are now, what you would be thinking going forward based on what's happened.
The Russian natural resource stocks for the last 5 years have been the cheapest natural resource stocks in the world, net present value relative to price. And we discussed the fact that some of that discount was appropriate given the lack of precedent, not just the lack of rule of law, but rather the precedent around natural resource extraction and foreigners' rights in Russia. And some of the rest of it was understandable due to the opacity of these Russian companies, despite the fact that some of them traded on the London Stock Exchange. But the cheapest natural resource market in the world, I would suggest that the companies were selling at half the values of their Western counterparts, fell by 80%. If you are a contrarian investor and speculator, the cheapest market in the world by 50% falls by 80%, what you're suggesting is that that's a dime on the dollar circumstance. In a dime on the dollar circumstance, where you understand the reason for the decline, if you are a speculator, you must participate. You participate with money that you could afford to lose all of or half of, as we stated in that interview, without it changing to your decision as to what to have for breakfast. I did that. My timing was almost uniquely bad. I was reasonably aggressive, which is to say a 5% portfolio position across 7 Russian stocks. Actually, it wasn't a 5% position because some of my orders went unfilled. The market shut down quickly enough that I got saved from my own aggression by the market itself. But let's look at what happened. Obviously, the geopolitical situation involved overt hostilities in the Ukraine. 2 things happened pretty immediately. The first is that the trading in Russian stocks got shut down in London, which is the market that I usually use to facilitate them. I don't trade on the Moscow exchange for various reasons. The second thing that happened was that Russia and Russian companies and Russian banks got frozen out of the SWIFT banking system. So the Russian companies, which I could no longer trade, could no longer pay me my dividends in US dollars. And probably I couldn't receive them in rubles. Or if I could receive them in rubles, I couldn't spend them. There is now the threat that the Russian government, given that Russian private citizens' assets are being attached in the rest of the world, will attach my assets in Russia, which is to say that my shareholdings in Russian stocks will be nationalized by the Russians and distributed as compensation to Russians whose assets have been stolen in the West. Whether that happens or not is a different circumstance. And I guess the last shoe to fall is that if I were to, as an example, open an account with Bank Pictet and buy Russian stocks on the Moscow exchange, it might be that my own government would act to preclude my involvement that way. What I hope happens is that the Russian companies, as several of them are discussing, institute a dividend reinvestment plan where, in lieu of receiving ruble dividends, the companies will buy more shares of themselves from my account, that we leave an off-ramp for Putin and Putin leaves an off-ramp for us, and we stop killing each other in the Ukraine, and we stop short of exchanging nuclear firecrackers, and that 3 or 4 years from now the world returns to normal. And the valuations associated with assets in Polymetal and Norilsk and Gazprom and all those fabulous companies means that my speculation worked out, albeit with a bit more trauma than I had expected and taking a bit more time than I had expected. But I'll tell you, Albert, in my life, I've taken lots of similar risks. I speculated in Congo on Tankefun Gurumi and Kilomoto in 1996 during the Congolese Civil War. Those speculations had a happy ending. I speculated with the Lundins in southern Sudan during their civil war. Those speculations had a happy ending. When you are a speculator and you understand something about the valuations, if an asset is on sale for a dime on the dollar and you can afford to risk a dime, in other words, where your downside is 10 cents and your upside, which is frankly often more probable, is $1, you have to take that shot.
Thanks for sharing that, Rick. Yeah, obviously, it's unpredictable times. How do you, in general, when you approach something like that with that much risk, you must basically assume that there's going to be, or the high probability of a certain amount of illiquidity, and having to see it through. And I imagine this was the case. What is the maximum sort of duration that you figure, that you factor in, that you might have to stick with this for, I don't know, 5 years, or how long did you kind of mentally commit to this thing when you did it?
5 years is not a long time for me. Tanke Ngurumi, which was the large copper deposit in Congo, I thought we might have to feed it for 10 years. It was, in fact, the largest undeveloped copper deposit in the world. And I thought it was probably worth my while. Your perception of time has to be flexible. It has to change. I remember very much the day before that interview doing the risk calculation. And what I decided is that I would risk 5% of my portfolio. And I thought in the near term, there was an equal probability of the stocks losing 50% or doubling. I thought that over 1 or 2 years, that there were two outcomes. One, I could lose 100%, which is to say that I could lose 5% of my portfolio. It's nothing that hasn't happened before, by the way. The alternative was that sanity would prevail to the world. I understand that's asking too much, maybe. And that my dime would turn into a dollar. So when I juxtaposed losing 5% of my portfolio or having that 5% become 50%, I thought, given what I do for a living, given how I made the money that I'm risking now, I must take this opportunity.
And in your experience, when you do that time after time again, what is the batting average?
Well, the jury's still out on this one. If we're using a baseball parlance, this may be a fastball to the face. That happens if you crowd the plate. But generally, when I have taken big risks that I understood, I've done well over time. I'll say that. That isn't to say I've always done well over time. I was early into Kazakhstan when Kazakhstan was more a place than a country. I lost 100% of my investment in Kazakhstan. I was early into Afghanistan. Funded something called Afghan American Mining. Lost 100% of my investment in Afghanistan. So I'm not trying to say that this strategy has been flawless for me. But what I am trying to say is that most of the money that I now invest conservatively, I acquired from speculating aggressively, never foolishly. This wasn't a circumstance, Albert, as you'll recall from the interview, where my critical methodology was not a hunch, bet a bunch. I thought through this a lot. I probably spent 20 hours on the phone with various middle managers who I know at these Russian companies. I had constructed at least back of the envelope net present value calculations. I knew in the case of every one of the companies what the major undeveloped assets were that they had, how they would fund them, what their production profile looked like. So in the context of the valuations, I had done the work. I made a political calculation that was more arithmetic than narrative oriented, which is to say, I thought that the outcome would be as much as 100% loss or as much as 1,000% gain. And the calculation around that, given the value proposition, was overwhelming for me.
Yeah, and it seemed like it was going to be that kind of binary outcome, didn't it? Either this is going to fix itself or something like what happened is going to happen.
When you take political risk in frontier and emerging markets, the outcome often is binary. It goes right or it goes wrong. That presupposes that the speculator is tenacious and persistent. Certainly,
Sure.
with regards to my investments in the Congo, it was never comfortable watching the nightly news. Maybe that's why I didn't do it. Watching 2 million people die on top of your deposits. More pleasant for me than for them, probably, but that's a different circumstance. But the realization of the Tanke Fungarumi speculation didn't really resolve itself completely. That is to say, I didn't have an exit until 2004 or 2005. So I had certainly 1995, 96, 97 with lots of trauma, psychological trauma, lots of volatility in the stock, lots of responsibility in terms of keeping myself informed and continuing to think. And I didn't recognize my gain for a long time. But if you go back to the Tanke Fungarumi example, that was a circumstance where the stock was selling for 20 cents. It had 30 cents a share cash in it. So I was paying negative 10 cents a share for the largest undeveloped copper deposit in the world, run by the Lundin family. What could go wrong? Everything. Everything. What could go right is precisely what happened. That 20-cent share got sold for $15 8 years later. Now, I'm not going to suggest to you, Albert, that I held all my 20-cent stock to $15. What I am trying to say is that all things considered, the risk was certainly worth taking. And it wouldn't surprise me in the 5-year time frame if the risk I took last year, despite the fact that it's punished me egregious since, won't pay me. That those companies are still best in class natural resource companies, all inclusive. There are enormous challenges around recognizing that gain. Russian challenges, British challenges, American challenges, a wide variety of challenges. And so I would say that while I'm not comfortable with that speculation, had I to do it again with the same information, I would certainly do it in the same fashion.
This is a bit of a tangent, Rick. You may be done with the stands at this point, but if you're not, I watched one of Doug Casey's podcasts on his YouTube channel. I don't know if you watch that regularly, but he had a money manager from Uzbekistan on with some interesting insights about what's going on there. So I don't know, maybe third time lucky with the stands. You may want to take a look at that.
I am trying to invest in the stands as we speak. Because of their proximity to Russia and because of some fairly well-publicized governance issues in the stands, I think that Western investors don't belong there. But I think that Western speculators, myself included, would be well advised to look in those countries.
Is that right? Because of rule of law, Rick? Why would most investors not?
I don't. Yeah, it isn't merely the rule of law, which would appear to be problematic in most of those countries, although probably improving in Kazakhstan. What's more problematic, I think, is precedent. In other words, even if you assume that they will apply the law with regards to most of their mining codes and commercial codes, their duration and the amount of precedent, which gives you the ability to calculate how the courts might rule, isn't in place. If you have a country that's mining code has only been in place for 20 years, and where the application of the code has been limited to 6 or 7 companies, 2 of whom are parastatals, the whole concept of the body of law, the whole concept of understanding how the legal establishment deals with questions hasn't been established. While I don't like the way mineral law is always applied in the United States, either I understand it or I have the ability to hire somebody who does understand it. That advantage I don't see in those countries. And then the interplay between the voters and the legislators in those countries, and developing a feeling for how those countries socially view extractive industries on the one hand and foreign investors on the other hand, isn't well established. So my definition of an investor is somebody who expects a reasonable return on capital employed. That type of person, because I don't think they have enough information to develop an expectation, doesn't believe in those markets. A speculator is somebody very different. A speculator is willing to take risks that he or she partially understands on a probabilistic basis, even where the probability is failure, if the reward for success is large enough to overcome the statistical probability of failure. In that part of my portfolio, which is the part of my portfolio that got all of the money that I now invest sensibly, I think that the stands represent very good risk to reward, particularly in early stage exploration, which is something I'm very fond of. Risk on risk, if you will.
Rick, is it also fair to assume that the disclosures in those markets are somewhat lacking, or at least less rigorous than what we're used to? If that's the case, how do you personally circumvent that limitation? You have boots on the ground, or what do you do?
Yeah, the risk disclosures that we have in this country are silly. It doesn't say anywhere on the discussion of U.S. treasuries, the borrower's insolvent. I mean, I'm sorry for that tangent. I have actually found in crafting prospectuses that disclosure of risks and conflict of interest becomes a selling point. That's how perverted the world is. So I assume that in a country like Kyrgyzstan or Uzbekistan, that there are all kinds of risks I don't understand. I just see that coming. What I also see is that I can acquire Landsat photography of those places, run it through, I can't, but I can pay to have it run through astroimagery program, and I can see structures from space, structures that are large enough that you can see them from space, that have never been explored with technology more advanced than a pick and a mule. In other words, the upside I see in the central and western part of the Tethyan metallogenic belt is similar to what somebody like me would have seen in the 1940s in the Chilean Cordillera, except for with all the modern tools. You understand where I'm going with this?
Absolutely, yeah.
The probability of every early stage exploration effort in the world is failure. And the probability of failure in a place where the mining law, the mining code, and the relationship between mining and society hasn't been established is greater yet. What is also great is the fact that from my point of view, the last great hunting ground in the world for massive copper porphyries is in the central Tethyan. And these massive porphyries, the Bingham Canyons, the Chuquicamadas, the Escondidas of the world, Grasberg, are mines that frequently generate free cash flows measured in the $2 to $3 million per day. They're very, very, very unique events. I haven't yet participated in the discovery of a tier 1 world-class porphyry. For financial reasons and also for reasons of curiosity and pride, I would love to do it. And I think the best place in the world for me to do that is the Central Tethyan.
I'll pile on to your tangent, Rick. I don't know if you remember, it was several years ago at our resource symposium in Vancouver. Jim Grant came, and I think he started his talk with a fictitious prospectus from the U.S. government, pointing out, correcting the inaccuracies that you alluded to in making your point.
I remember that very well. I remember being on stage with Mr. Grant and being engulfed in laughter through most of his presentation. So it's a fond memory.
Okay. What I want to do now is I want to shift back to uranium. We had that uranium boot camp, which a lot of people, fortunately, were able to attend, and it generated a lot of questions, so many that we weren't able to get through all of them in the Q&A that we had scheduled you for at the end. Our time just was insufficient to get through them all. So, these questions are a little bit old at this point, but I think it's still worth revisiting them and then putting them in, I guess, the context of where we are now. So these are arranged, there's many of them, but they're arranged in popularity because the platform allowed people to upvote questions. And John Luke asked the most popular question, which was, how do you see the future of thorium reactors?
A disclaimer, first of all, I'm not an engineer, and so I don't understand all of the technical aspects of the debate between thorium and uranium. What I can say to the questioner, I think it's a great question, by the way. What I can say to the questioner is that people who are smarter than me and people who write bigger checks than me are building about $200 billion worth of uranium reactors worldwide and one bench scale thorium reactor. So if you follow the money, and I'm not trying to say that the money is always right, it would seem that the preponderance of confidence is on the part of uranium. Certainly to the extent that thorium technology takes hold, and I'm not saying it won't, I don't know. The impact of the thorium technology taking hold won't happen for at least 10 and much more likely 15 years. The net present value of free cash flows in the uranium business from the levels established today won't matter much 10, 15, or 20 years from now. If thorium technology advances to the point in time where there is a substantial capital shift from uranium to thorium. There's no evidence right now that that's going to take place. Thorium thus far has seemed particularly useful in selling financial newsletters. It's been a wonderful sort of black box to attract subscriber dollars. But I notice that the amount of dollars that it's attracted from utilities and power producers relative to uranium is non-existent.
And I know obviously much less than you or even the people asking these questions, but my experience in technology is even if this was the roadmap, temporary technologies, temporary solutions can last decades, if not longer. So let's go to the next one. Let's see, from CK Lim. Say strong uranium demand for the foreseeable future is clear, but most miners' share prices have gone up a lot. Are we already overvalued territory and have to wait for fundamentals to catch up?
At the time the gentleman asked the question, with regards to the microcap uranium stocks, the answer was clearly yes. And we tried to say that in the Uranium Bootcamp. What we tried to say was that on a risk-adjusted basis, the larger companies offered better valuations than the smaller companies. Some of the smaller companies had more upside, but you encountered a lot of risk. After the conference, the euphoria around the microcaps continued and became insane. Some of the uranium juniors over the last 5 or 6 weeks have fallen by as much as 50% in price. That doesn't mean they can't fall further. So I would say to the questioner, it really depends on the stock. When I say we, I really mean Aditya Patanayak and myself, have compiled a list of 12 uranium stocks out of a universe of 75. And we've been constructing portfolios out of those 12. I think thus far we've managed to buy 5 of the 12. I don't think this is a circumstance where necessarily you want to buy the waterfront. Paraphrasing the movie, The Good, the Bad, and the Ugly. No, there's way too much bad and ugly and not enough good. I do, however, believe that absent a worldwide depression or recession, that the incentive price for new uranium projects, which the world needs, is easily $70 to $75 a pound. The AISC requirement for maintaining current production is probably $50 a pound, and the spot price hovers around $50 a pound. I think, too, that because it takes a long time in capital-intensive businesses for the supply side of the equation to react to prices, that we could easily go through $75 a pound and overshoot to some number like 100 before market prices took hold. If you rerun the calculations, the net present value calculations that we've done, cursory to be sure, we used a $60 valuation number on uranium, whereas today I'm comfortable using a $75 valuation on projects that are going to be in production 3 years from now. It changes the valuations. Unfortunately, many speculators, probably not necessarily the ones who came to the boot camp, but many speculators in uranium are there as a consequence of the narrative. They haven't done the work to understand the valuations relative to price.
Next question from Stefan Vandergaag. And bear in mind, these questions were from March. What do you think about the recent recommendation to put the LME to suspend all commodity deliveries from Russia, in particular copper, aluminum, and nickel?
I think that every investor in the world needs to make their own moral decision about who they trade from, who they trade with. I think the LME had several considerations, all practical from their point of view. The first was the political appropriation that they would face if they continued to maintain trade in Russian commodities. But the second was the absenting of the Russians from the SWIFT banking system, which meant that functionally LME members couldn't pay the Russians for the material. I mean, kicking Russia out of the dollar system made continuing LME function really impossible. The third thing, of course, is that in addition to the LME and Russia itself facing sanctions, there is and was the threat of sanctions against banks that facilitate the transactions, against companies that ship the material from Russia to LME accepting warehouses worldwide, the virtual prohibition on ensuring the shipments. So I think from the LME's point of view, they had no second choice. I think it was partially a politically driven response. But I think even without the politically driven response, the overall impact of trade sanctions against Russia as it relates to commodity production has been more dire than people think. Maybe less dire with regards to natural gas because the Europeans felt for political reasons that they needed it. But the rest of the LME complex, imagine if you can't pay your vendor. Or imagine if you can't insure the shipment, or if you can't ship it at all. There was more to this than liquidity in a metals market.
Okay, this next question from Matthew Lenton is a question you answer frequently, Rick, but we have new followers, and this question was very popular, so I'll ask it. What is the most important metric, or what are the most important metrics for evaluating speculative miners?
Boy, that's tough. There are 8 or 9, and that's probably something that we should do, you and I, a whole segment on. I haven't done that for probably 10 years for people. If you define speculative as really, really, really early stage, which is one of the ways that I define it, and I suspect the way that the person asking the question is defining it, I think it gets down to people. I've seen, as an example, the Lundin family pull rabbits out of a hat that I never expected them to be able to pull out. And I've seen other lesser lights strive mightily and snatch defeat from the jaws of victory. So I would say that having a management team that's heavily invested with their own money, so they share the pain if things go wrong, but more importantly, share the gain if things go right. The people that have a historical track record of success, which means that they can attract support during tough times, and people that have expertise, and that expertise has to be applicable to the task at hand. If somebody was successful building a marijuana grow-out operation in Colorado, and now they're involved in uranium exploration in Kazakhstan, while they've been successful in the past, the success isn't particularly appropriate. I would also ask people in speculation to understand why they're doing it. That too often people want the psychological reward of being right, which means that they take a speculation, but they take a speculation for a greater probability, but against a smaller stake. If you are going to risk 100% loss, which is not uncommon in speculation, you ought to be looking for a 10 or 12-fold gain. When I speculate in mineral exploration, what I'm looking for, my target size, it has to be defensible. It has to be in excess of $2 billion net present value in situ reserves or resources. It has to have the potential to be in the best quartile worldwide in terms of total cost, including amortized capital. And it has to be potentially in the best quartile worldwide on return on capital employed. I'm not particularly interested in taking a lot of risk or even a moderate risk for insufficient reward. And too often I've seen speculators who are willing, as an example, to finance small mine speculation because it has a higher probability, although it's still improbable, of success. The idea that I would take big risk for small reward is incongruous to me. I'm all for taking big risk, witness my Russian adventure. But I did it because I thought that I had the potential for a 10-to-1 reward in the biggest and finest natural resource companies in the world, a rare circumstance.
Rick, I've heard you say that many times, and that's a lesson that I think I've had great success incorporating into my personal life, and that is the reward versus the outlay, whatever that is. Right. And so that's something that I hold dearly. That
perhaps
question,
you can teach me that.
I'll try. That last question comes at a good time because just to share something with the viewers that happened today, we were on a call with a mining CEO. And Rick, you momentarily forgot the name of the company name, the legal entity name.
Yes.
However, you knew everything else that was important about the company, including the CEO, this person's background, the partners, the property, the cash flow, the SG&A expenses. You knew everything that was important about the company, but maybe the name and the marketing and that kind of stuff, not so important, was my takeaway.
Yeah, I guess that's right. Tio could remind me the name of the company. So that information wasn't particularly important to me. Understanding why I made the investment was very important to me. There was a point in time in my life, Albert, before you and I knew each other, when I was very young, that narrative was important to me, that the wrapper was important to me, that all that stuff is important to me. I never made any money from it. So the consequence of that, and I guess perhaps my training as a lender, means that the wrapper is less important than the goodies that are inside of it.
Right.
And I happen to think that her company has a lot of goodies. The fact that I couldn't remember the name might have to do with the fact that I'm 69 years of age now.
I think it's because you remember what's important. Everyone has finite resources, and that's my philosophy anyway. Why bog yourself down with things that maybe are not important? I got one more question. And it relates to the Sprott Uranium Trust and its attempt to be listed on the U.S. exchange. Time has passed, so we know what the outcome was there. This was not approved. But the speculation was, when was this going to happen? But I guess now the question is, why was that pursued? What is the consequence of it not taking place for the uranium market?
I want to disclaim this answer by saying that I'm speaking as Rick Rule, not as a Sprott employee, because I'm not. I'm a Sprott shareholder, and I make my opinions known to Sprott, but this answer shouldn't be regarded as being one that comes from Sprott, but rather one that comes from me. I thought that the U.S. listing was important because Sprott has 200 and something thousand investors in the United States who are invested in other aspects of the physicals franchise. The gold trust, the silver trust, the gold and silver trust, the platinum and palladium trust. And I thought and think that Sprott has substantial value off balance sheet in that franchise, which could be brought to bear on the physical uranium trust should it trade in the New York Stock Exchange. Further, the Canadian exchange, while the Toronto Stock Exchange is a great exchange for natural resources, particularly because of their regulatory intelligence and flexibility, it's an illiquid exchange. Canada as a country is overserved in natural resources, which is to say that the percentage of natural resources companies relative to the importance of natural resources in the Canadian economy is oversized and it's overserved. And so migrating a financial product from a small market that's overserved to a big market that's underserved is a fairly obvious advantage. The depth and liquidity on the New York Stock Exchange is unrivaled anywhere in the world, and we would have benefited from that. I'm delighted that the world is becoming connected enough and is less ethnocentric enough that even being on the Toronto Stock Exchange, that we now have a $3 billion market cap and have been able to raise enough money to buy in excess of 50 million pounds of uranium in the world. And I am delighted that American investors can, in many cases, find their way to Canada to do that. There are still institutional investors in the United States whose charter prohibits them from entering foreign markets. And some of these institutions, I ran into one the other day, about $2 billion, are reasonably decent size. In addition, there's a whole generation of American investors who are investing through discounters and online. And in many cases, those investors don't have access to foreign exchanges and so don't have the ability to arbitrage the difference between the Canadian quote for the Sprott Physical Uranium Trust and the quote for the same security trading in the U.S. over-the-counter market. So I would have preferred the liquidity on the New York Stock Exchange. The New York Stock Exchange and the SEC and FINRA made a decision, which I understand, based on the facts at hand. I think it was unfortunate for the uranium industry and certainly unfortunate for investors and unfortunate for Sprott.
All right, thanks for that clarification, Rick. That's the time we have for the questions. There were some people in the comments and elsewhere expressing a little bit of regret that they had missed out on the boot camp after it was over. And I want to point out that there's another opportunity coming, this time in person, for you to participate in a Rick Rule Investment Media event. So, Rick, why don't you tell the folks about what's coming on July 26th?
I hate to keep contradicting you, but this is a Rick Rule Albert Lou event. The reason why I appear so calm is because you appear so stressed. This conference will be a continuation of the conferences which we have put on in Vancouver for so many years, the former Vancouver Natural Resource Investment Symposium. Our audience, Albert, told us after 2 years of COVID that they wanted a live conference. It's probably easier for you and I to do a virtual conference, but the customer is always right. The consequence of that, and the consequence of the fact that due to public health restrictions, I didn't have the courage to put the conference on in Vancouver when I have so many American customers, meant that we've moved this conference to Boca Raton, Florida. We're taking over a spectacular hotel property down there with room rates frequently in excess of $1,000 a night, which we're able to turn to our attendees for $300 a night. We, largely you, have put together an absolutely fantastic faculty. I think the value proposition comes at least 4 different ways. The first is that the conference has always attracted great, out-of-the-box, big-picture thinkers so that investors can get out of their own lives a little bit and look at aspects of global macro that they hadn't considered when making investment considerations. And, we've always done a good job of that. We've got Jim Rickards, we've got Daniela DiMartino Booth, we've got Doug Casey, we've got Grant Williams, we've got a variety of speakers who you just are not going to see on CNBC, maybe with Daniela aside, and you're certainly not going to read them on the pages of the New York Times. And I think that's important. I actually think more importantly, Albert, once that big picture lesson has been framed for you, we have people where the rubber meets the road. The living legends, the people who have built multi-billion-dollar resource companies from scratch, talking about how they built the companies and talking about how the lessons they learned made them better investors and can make you a better investor too. I actually think that's more valuable ultimately than the big thinkers. The big thinkers might tell you why, but these guys tell you how. And without the how, the why is maybe less valuable. And then I think the real unsung success of our conference, going back years and years and years, has been that every exhibitor in the conference is actually vetted. If we don't own that company in a personal account or in a managed account, they're not allowed to exhibit. Now, sadly, just because I own something doesn't mean the share price is going to go up. Witness the Russian stocks. But what it does mean is that unlike other conferences where the qualification for exhibition is a check that cashes, every single one of our exhibitors has been vetted. So this combination of a fine facility, wonderful conference organization, thank you, Albert, big picture paradigm from the gurus, how to from the living legends, and then opportunity, vetted opportunity on the part of the exhibitors is, I think, what's made this conference such a success over time. As with all of our educational products, if you come to the conference and don't think that you got your money's worth, we'll refund it. We are comfortable enough in our value proposition and have been comfortable enough in our value proposition going back 25 years that every educational product from Rule Investment Media comes with an ironclad money-back guarantee. The financial risk is ours.
Thanks, Rick. Just taking down a note here to register rulelusymposium.com. But for now, folks, you got to go to rulesymposium.com to get information about that. And I love the big thinkers, and there were a couple that you didn't mention that are important. Nomi Prinz coming back again. David Stockman returning after several years since he last spoke with us. So it's going to be great. And I do agree with you. Those lessons from the legends. Last year, it was Ross Beatty. Just amazing. I mean, we had the panel, but we also had a one-on-one with Ross Beatty, which was just illuminating because he went back to the early times of his career, talking about, how he made a name for himself as a young geologist. This year, we're going to do the same with Sean Rusin on stage. So I think that's just going to be brilliant. So that's rulesymposium.com. Don't miss out on that. It's going to be fantastic. Boca Raton, July 26th. Rick, any parting thoughts for the viewers?
I think we've given people a lot today. I think they need to digest it. I think you and I need to do this more frequently. It's been fun for me, and I get literally hundreds of emails after these things saying, do it again. So let's do it again.
It's impressive, Rick. You threw in a call to action in the last 30 seconds of a 1-hour video last time without warning, and the response was quite impressive. So credit to the viewers for sticking all the way to the end. Really appreciate that. And I do enjoy it too, Rick. So let's get more of these in. I have so many more questions from people about uranium and other topics, I'm sure, because the markets, as we talked about, will be volatile going forward. So look forward to it. But for now, enjoy your weekend, Rick.
And you, thank you for causing this to occur, sir.